So today we are going to be talking about internal structure. I'm going to be explaining to you how internal structure actually works, and I'm also going to be showing you, right. We are going to be looking at the example we previously looked at for that we the trade we took on, was it on Saturday? Yeah, on Friday. Sorry about that. So the trade we took on Friday, which I ended up making $700 from it. I'm going to be showing you all that we did on that trade and how we break down the trade. But first of all, before we do that, we are going to look at a line diagram so that I can explain to you the concept we use in looking at that trade. So let's say we have our market. The market is actually pushing up like this. The market has already taken out our inducement. It has gone ahead to create our impulsive leg. Now, after creating this our impulsive leg, right, what we are going to look at for next is if we want to take a counter trend. I already know that, okay, if you want to take a counter trend, the next thing we are going to look at now is we are going to concentrate on the recent leg of price. Once it gives us a change of characters in a smaller time frame and starts trending down like this, then you can start getting that interest to get involved in the market. So basically, this is what we look for once the market has given us a change of characters in a small time frame and shows that our retracement has started. Okay, so once this change of characters has occurred here, right, and you see that this market is trending in a downtrend, what you are looking for now is to get involved in this downtrending market. Now, when you're analyzing your market, right, you're analyzing your market, you have already determined that you have a break of structure here. You have your break of structure here. You have your inducement. And you also had an inducement here. So if I happen, let me label this out. There is no true trend in a market. Let me keep it this way. There is no true trend in the market when it comes to smaller time frames like 4 hours. 4 hours is a smaller time frame in the market. If many people don't know about it, that is like a smaller time frame in the market. We will have time frames like 3 months. So when you come down to these time frames, you are either trading a pullback or you are trading the right direction in an internal market. Or let's say I can still be trading, I can be taking buys, but I'm somewhere around here. In a bigger time frame, there's still a big break of structure that is supposed to occur somewhere here. So this is what I mean. If I'm trading, if I'm taking buys here, I might still be in a bigger time frame, I might still be not truly aligned with the bigger structure. Though I'm trading the internal direction in the internal market in that direction, but on the 1 month, I might be inside this range. So it's until the market explodes out of this range before we see. And those big trends, those bigger time frames, they are they are going to have a lot of internal structure. So you need to learn how to trade internal structure according to market structure, or you will spend days, you will even spend months without seeing a trade in the market. So being smart and being able to trade that will differentiate you in the market. But I did not say you should go down to the 1 minute and be doing that. A pro can do that, but if you are still beginning, it's good for you to stick to a moderate or a medium time frame, at least 1 hour. But you make sure you do top-down analysis because all of this, right? This will not be identified on your bigger time frame. This will be identified on your big time frame, right? But this one has to be a medium time frame. This one is a different time frame from this one. When this market is trending up here, right, you will see on this time frame, this is a structure you are going to see. But when you start switching down to a smaller time frame, this is a structure that you are going to start seeing. So once you start noticing that, okay, this structure on a smaller time frame is already indicating that this market here is in a retracement phase, then you can look to get involved on this retracement phase. Now, This retracement phase also have it has its rules, right? How do I get involved here? Now, let's say I want to look at this market. The first thing I want to do is I look to the left. When I mean I look to the left, right? If this market currently is here, the first thing I want to do is look to the left. Now, the reason why you're looking to the left is to make sure that this market is currently not in a POI. So once I look to the left, I identify that okay, my POI is somewhere around here. This is where my POI will happens to be. And I know that okay, this market is not reacting from anything here. So the next thing I will want to do is I want to find out now where is the liquidity in this smaller in trend. So if we look from here as current market direction, we'll spot that this is where the liquidity is. This high is where the liquidity is. Though you might say that this was a valid break of structure here as well, right? This was a valid break of structure. I'm not disputing that. But now what happened is there was no liquidity on this previous leg of price. So this high might end up being taken as the liquidity to move down and mitigate this. Then there is also one more thing, right? When you're looking at this, these lows below, these lows that are closer to your POI like these lows, they act as liquidity. Maybe somebody here will mark the POI like this. And once the market has not truly mitigated this POI, but it has given all them some sort of a false change of character here, they will be thinking that okay, once the market now comes back down, they'll be thinking that okay, once this market now comes back down, I can buy and go up. But at many times you will see that the market will come down and go down right to your POI to fully mitigate it. So majority of the time, or let's say 60 to 65% of the time, the market always come back and mitigate at least to your 50% of your POI before it goes up. So now here, what we want to do is we wait for this market to grab this liquidity above that high, and then we can look for our position here. Let's say this market had an inducement, right? An inducement here. Then once it comes up, it takes out this inducement, and then our POI now can then shift to our current range in the market. So in this point, this will be our current range, and we'll be looking to sell the market from here. Now, once we sell this market, right, we are not going to target this POI. Sometimes I target a POI, but it's more risky. What I tend to target is the liquidity resting below these lows here. So your entries structure doesn't just act as a way to get the bias of the market. It also gives you an idea of where to target in the market. And it's quite simple. If you look at this is what we look at in this structure. Somebody will come to the market. The first thing they are going to do is they are going to see something like this. Now, when you come to the market, you see something like this, you are already excited that oh, this market is super bearish. Now, from you here, what you are going to see is you are going to see maybe something like this. The market has broken above this small structure here. Now, once this market has broken above this small structure here, you think, oh, my inducement has been taken out. Let me look for a sell position up here. But now, the reason why this will not work in this case, though it has followed all the examples of this bearish market, is because you just fail to look to your left. You just fail to look to your left and realize that this POI is sitting right here. Looking to your left is very important. If this POI is sitting right here and then you are looking at this with without taking into consideration this POI to your left, you are going to get wrecked here. You are going to get stopped out here. And when you get stopped out, you will see it clearly. It's because you did not concentrate, you did not look to your left first. So here, this market has already given us a change of character to the upside. Once it comes back here, it's going to explode to the upside because it tapped into a point of interest to your left. So when you come into the market, zooming out, right? When you come to the market, it's good for you to zoom out and try to establish the full picture of the market. You establish a narrative that will suit the current market conditions, right? We establish a narrative that is according to the current market situation, to the current market. You make sure that you get the narrative right so that when you are trading this, you already know in your head that I'm trading a counter trend. I'm trading a pullback. This will be a full trend. Oh, this will be a full trend. But you should know that this trend you are trading is also inside another trend. The market majority of the times, what you are trading will be a trend inside another trend. If you look on the bigger time frame, you always realize that I'm trading a trend inside a bigger trend. The only difference is that some of the trends will tend to last longer than the others. Some of them will tend to last longer than others. And you can easily distinguish that by switching into, once you have already identified that this market is going up. Now, on your top-down analysis, this is why top-down analysis is very important. On top-down analysis, I might look at the daily time frame or maybe the 4 hours time frame. I'm looking to buy here. Now, you might be a day trader, I'm a scalper, right? I look at the daily time frame, I'm looking to buy. But now, when I come down to a smaller time frame now, I start seeing more of sells than buys. Now, it doesn't mean that my buy bias on the daily time frame or on the 4 hours time frame was wrong. It just means that on the smaller time frame, the market has not yet aligned with that my daily bias for the buys. So what I will need to do is I will need to continue with this internal structure until the market aligns with my buys. Right? I know clearly well here I am looking for buys here. I know clearly where I'm looking for buys. But once I look at this structure, this internal structure on the lower time frame, I start seeing more of sells. That is why on Friday when we took the trade on USD on AUD USD, I have people that kept telling me that they were looking for buys. Technically, there was nothing I could tell them because they were not wrong. They were not wrong. Why they were looking for buys, we were looking for sells because we understood this important role here. The market was not coming from any POI. They were expecting a reversal, but the internal structure has not agreed. Before the market will reverse from this POI, this before the market reverses from this POI, this internal structure already tell you the story. This internal structure is like an indicator. It tells you what is about to happen on this big structure. Without a significant move here or without a clear change of characters here, there's sometimes whereby the market will not really tap into a point of interest, but it will give us a change of characters. Now, how do we do in that case? Let's say we have something like this. So we can clearly see we have our break of structure at this point. Now, if this move here starts retracing like this, creating higher highs, higher lows, higher highs, lower lows, lower highs, lower lows, lower highs, and so on and so on. There is a chance that this market might reverse from here with just this, right? It just happens like this. The market has gone up. Now, before this market reverses abruptly like this without tapping into a point of interest, it will also give you a sign on this structure here. This structure, you can remember that I earlier told you that this structure is also a trend. This trend can reverse at any time as well, just as this other trend. But it will tell you here that, okay, my trend here is also changing. It's also changing. Your smaller time frame will not only act as uh, a direction for a buy. If this trend decides to change without tapping into any POI here, it's still possible. But you also see it in a trend. Once it changes, you will see it in a trend. You'll be able to identify that, oh, here I had my inducement here, right? This inducement got taken out. I had my break of structure here. I had my break of structure here. This break of structure was valid and I had an inducement here. So I had a trade. This was my inducement, right? This was where I had the inducement and I had this my high here. This was my protected high. So the market has taken out this my protected high, and it shows that this trend has changed, even though it has not tapped on any pure high here. So this is still a valid trend change. This is still a valid trend change, and it will also give you an opportunity now to buy here without having to necessarily look at this zone here. But when you are trading internal structure in the direction the internal structure is trending to, you always need to look at the left here, because we wait for the market. We normally wait to take trades once the market has mitigated our left side pure high here before rallying to the upside. So let's not waste too much time here. Let's switch to AUD USD and look at we had we had this market here. Basically, this market was trending up, but at some point in time, the market gave a change of characters here in a smaller time frame. This was where our last break of structure in this market was. According to our 1 hour time frame, this was where our last break of structure was. The market took out this low here, which was acting as our inducement, and then the market started reversing. Now, when the market got here, right, what people needed to understand was this market had a new trading range once it took out this low. This was where a change of character indeed occurred in this market. Many people were so fixated on this zone here because they were expecting a reaction, a big reaction of this zone, because it gave them this momentum here. This was a high momentum buy here, and they were expecting the market to tap into this point of interest and give them a change in market direction or a continuation to the upside, right? So once this market got tapped into this zone, the market just broke through. When it broke through, the people were seeing it as a sweep. I went to the smaller time frame. I did not see this as a sweep. I saw this as a continuation. First of all, if you look to the upside here, you also see that this market had a higher sweep here. Now, this sweep here was not a coincidence, right? If you go down to a much smaller time frame, you are going to see that after when you go down to a smaller time frame, right, you are going to see a lot of internal structures. You are going to see a break of structure here. You are going to see another internal break of structure here. These are minor break of structures in the direction of the market. So when you see this, right, you see that this market here happens to give this move here and gave us a change of characters right around here, and then went ahead to sweep this. So once it swept this, it shows us indication that the market was willing to continue pushing to the downside. So all you needed to do is follow the right direction of the market. Beside this internal structure here had already this structure here has already switched bearish. This zone will not be active, and you can see from this zone took out liquidity, mitigated our zone here, and this was why this move was so huge, right? Once the market has taken out liquidity, the moves are always huge. If you look here, this market has taken out this liquidity, dropped very fast. This one took out this liquidity, mitigated the demand zone here, and rallied very fast. You can when you start seeing price action like this, you can see that there was no clear bias in the market. There was no clear liquidity that was taken here. So the market was a very choppy. So once we identified that, okay, this market was up, this was our current structure in the smaller time frame, which was our internal structure, then all we needed to do is identify what we talked about on a smaller time frame to get that trade here. Now, you might be asking, right, where are we on a bigger time frame? Look at this. This is our bigger time frame here. This pair is totally bullish. This pair like this. Okay. So, like I was saying, right, on a daily time frame, you can clearly see that this market here is bullish. This is a bullish market. And here people will be here waiting for this market to come back to a pure high here, or maybe come back to a pure high here so that they can buy. But this market, you know how long this market will take. This market will probably take months. This is a daily time frame, right? This three candles like this represents one day. So imagine how many more candles will come before the market maybe mitigate a zone here that it can actually buy. It will take a long time. And you can also see that here, right? Here we were also trading internal structure. We were also trading this daily internal structure here. Each of these continuations we were able to trade them using a medium time frame. This internal structure aligned with the proper daily time frame, right? But it was not actually the daily structure. So that's what I was trying to explain to you. I saw this on the daily time frame. I knew there was no significant resistance zones here that the market could react from. The closest zone which I was looking at was already this order flow here, and then this extreme one. So looking at that, I had that bias. And going down to the 4 hours time frame, we saw the possible trend change here. After this trend change, we are looking to continue the market down. This was the daily order block, right? The daily order flow I was showing you about just now. This is the daily order flow here. I refine it down to this zone here because if you look at it critically, you can see that we have just this order block on the daily time frame and this demand zone on the daily time frame. All of these here are probably noise. All of these are probably noise. It's time for us to focus on this move. We focus on this move. So once that narrative was already gotten, I got to focus on this move. And on the 30 minutes time frame, sorry, 15 minutes, you can clearly you can now clearly see the structure, right? You can clearly see the structure now. This structure all the way, it started from here. This market took out this internal liquidity here, tapped into this point of interest, sold. Once it sold, it came back, took out liquidity here, tapped into this point of interest, and then sold again. So once it comes back up here, it takes out this liquidity and it taps into this point of interest. It sold, then came back to retest this point of interest. So this is where we got our trade idea, right? This market, if I go down to a much smaller time frame, this was a very smaller time frame trade. If I go down to a much smaller time frame like the 5 minutes, you are going to see that this was our inducement here. The market took it out, so gave us a break of structure. Then we had a new inducement here. The market came, took it out, then tapped into this point of interest. When it sold for some time, then came back up to retest this supply zone here. So once the market retested this our supply zone here, we looked for our trade here. This was where I sent you the trade. I sent you the trade. The trade had already dropped a little bit to this zone here, but the market still pushed the trade now to accumulate the remaining orders at this small zone here and finally dropped. Immediately it dropped, taking out this liquidity on the resting below this low. It started reversing. So there's one thing you can see here as well, right? We have people that trade structure without understanding. Those that were trading looking for buys, this is probably the place where they identified as their change of characters, and from here they identified this as their order block and bought from this zone. Now the idea behind the liquidity under this low and this lows here came from this trade. This will definitely be what the people that did sniper were looking at, and the people that were in for a less risk to reward ratio trade were looking at, and maybe they were targeting all the way to this high, and the market finally swept them out. So for this market to reverse here, right, even as the market stands now, I will not take any direction to either sell or buy until the market gives me a clear POI on my bigger time frame, or the market gives me a change of characters by going above this high. If the market can go above this high, then I can then look for an entry. You trying to buy from a zone here like this will be disaster. Though we have this accumulation here and the market tapping into this zone might present an opportunity, but this is still early. There's no need for you to want to buy the market when it has just started reversing. Now, majority of the people, they always want to catch a trend. Let's say the market is going up like this, the market reverses like this. They always want to catch this first move, this first after this change of characters. They always want to catch this first move of this sell here. You must not catch this first move, right? You can wait for the market to drop, create inducement, then it comes back up. You buy it from this zone. There's no need for you to hurry and buy from here, which you are not certain, because majority of the time, if you make a mistake here, the market will just continuous up. Once the market starts trending down, it gives you more confirmation and more narrative in the market to actually know that, okay, this market like this is my internal structure. Don't force internal structure to catch it when it begins. You can always follow it later. Don't try to catch it when it begins. So this was a trade we had on the breakdown as well. Then we can go back to Euro GBP, the trade we did on the trade we had a look. We looked at the last class and how it behaved. So basically, this was an internal trade on a bigger time frame. So first of all, first of all, let me zoom out. Right, when I told you when you come to the market, you need to zoom out. When I came to this market, I zoom out like this. I did my analysis, identified this last break of structure here. I identified that this last break of structure got violated, right? The low got violated, and we had a change of characters to the downside. When you had this change of characters, initially you could have sold from here using an extra confirmation. Like you, when the market comes back to this zone, it gives you an extra confirmation, something of this sort like this, right? What I mean is something like this, and then we can sell. But definitely, I don't know where I was, but I was somewhere else and I did not get that trade. Now, when this market dropped down, when it dropped down, we identified this pool, we identified this internal structure. After taking out this low, right, we identified the start of this internal structure. Now, I did not rush to buy here. I did not rush to buy here. This trade like this, I gave you this trade in the group some time ago. That was over, let's see, that was over 109 pips. I send this trade. If you go back to the Telegram group, you look at it critically, you are going to see this trade was there. Now, when this market gave me this internal change of characters to start trending up, I did not look to immediately buy from this demand zone here. I did not even notice that this demand zone was here until the market had gone ahead to create a new break of structure, a new internal break of structure to the upside. And then when it came back now, it was where I realized that this internal structure has already shifted and the market is pushing up maybe to mitigate this zone here. There were also other things. This is a liquidity pool here. This is a bunch of liquidity pool here, right? These are trend line highs here. It all contains liquidity pool, so we expect the market to rate all of them. So when I bought here, I targeted this high. When the market got in very close to this high, it did not take it out. So it started retracing back. Now, using the same knowledge we talked about on internal break of structure, this was our break of structure here, right? This was where we had our first TP1 at this internal break of structure, because there were still orders here. There are people that were seriously selling to align with this trend, but forgetting to know that this is also a trend in its time frame. So once the market gave us this break of structure, when it came back, we identified this pool of liquidity here. We identified this pool of liquidity and this other block directly below the pool of liquidity. So this is where I told you that last week, when the market comes back to this zone, we'll be looking to buy and finally target this. Now, this is also a liquidity zone. This zone here contains liquidity. Now, many people are not going to understand the type of liquidity that this zone contains. This zone came very close to this pure I, and this zone acted as an inducement. Many people thought, oh, some people that mark pure IS on a very time frame, they'll maybe think that, okay, this is where the switch has already happened. I'm going to start looking to sell. So that is why maybe this move came about here. So when this market came back here, the market targeted only the liquidity. You can clearly see from this zone here, right? This was the liquidity that we created. You can see that the market wicked below here and then went up. So it just came down here to target this liquidity, not to tap into this point of interest. If somehow I was vigilant and I was studying this pair enough, I should have noticed this this sweep here. But unfortunately, I did not. The market swept it, continued to the upside. It even came back down to mitigate this last unmitigated order block here. Now, there is an entry model which I talked about that majority of the people don't yet know about. It's when the market sweeps an old low. When the market sweeps an old lows, goes ahead to create a change of characters. When the market sweeps an old lows, it goes ahead to create a change of characters, which it rightfully did here. Then you don't need an inducement on this leg to enter this trade. The market has already taken the liquidity it needs to move. There is no need for you to wait for an inducement on this leg. You can buy at the extreme order block. That's just simple. We might have gotten this trade if I was that vigilant, but I was not. I was focused on AUD USD, and one of these days I just decided I never wanted to trade, and I was sleeping the whole day. So basically, this is how we follow up internal structure, right? Always remember to look to the left before you trade your internal structure. Look to the left, make sure you are not in any significant zone that might likely reverse prices. Then you make sure you mark your internal structure correctly and you wait for proper confirmations before you look to trade it. The move we might be trading here, all of these moves like this, you might be saying that this is a counter trend. But maybe if you want to switch over to maybe the daily time frame or even the 1 month time frame, you are going to see that this move will be aligning with our monthly time frame goals, because it does. Honestly, if I show you from what I see here, it's this market is bullish. Break of structure, another one here, and the market even mitigated a zone here. So you can see that what we are considering in a counter trend here in this time frame is also a direct trend in a bigger time frame. So that is just as simple as that. Always look to the left when you're trading internal structure, or even when you're trading your external structure, right? You still need to look to the left. You don't know what might be hiding in the left side. You'll be caught off guard if you don't probably check your left side anytime you're doing your analysis. And always do top down analysis. Always do top down analysis. That is very important. I used to do just my normal analysis. I go to my one time frame. When I enter the market, I'm just looking for an instant trade. Now, when you look for an instant trade, there are things that your brain will tend to make you to personally not see. So it's good that you be a narrative, you wait for the trade to get to where your narrative, where your strategist tells you that this trade is getting to, and then gives you the proper confirmation before you buy. Some of us jump into the market today, we deposit on Monday, you want to see a trade that very Monday to trade. You are now forcing the market to show you the trade, not waiting for the market, not waiting for your setup to form properly. So always make sure you do top down analysis and wait for it to come to you, and then you can execute. Then there was one thing also I've been suffering with, which was risk to reward. Majority of the time, I'll enter my trades when they have already started moving. Now, what I tend now to do is just set my limit. Once I have my confirmation, I'll keep my limit there. That is why you have seen that I've been able to flip very small accounts, because majority of the time I used to like wait for the market to come to my point of interest and I'll execute manually. But I discovered I always somehow get in at worse prices. So what I try now to do is I try now when I once I get my confirmations, I just send my limit orders. That will ensure that I get in at the best price and I maintain my strict risk to reward ratio. So I think that will be all for the class. If you have a question, you can raise your hand. Then we see what we talk about. We do about it. So if you are watching this video from YouTube, please make sure that you subscribe. And those that are in the class, even if you are not going to watch the video again, it will really help me if you could share the video. Or there's one thing that there's one function that the YouTube has brought in now, right? It's called recommend. You can just go to the video, you look at it, and you click the recommend button. If this video helps you, right? If you learn something from this class, then you click the recommend button. And if you're watching this video on YouTube after the class has ended, then please click the subscribe button, right? And leave a comment what you think about the class for today.